Welcome back to all of you to this session at Deep Value Summit 2013. We have an in-depth idea presentation ahead of us that I really look forward to. This session will work as all of our sessions do, with Oliver introducing our instructor with some prepared remarks and then a Q&A session. As always, feel free to type your questions into the online interface at any time. Oliver, please go ahead.
Thank you, John, and I want to welcome all of you, and a special welcome to Christian Olesen, the investment manager of the Olesen Value Fund. I have been impressed with Christian's investment process and the quality of his ideas for some time. I've had a chance to meet Christian recently in New York. Christian started his fund in 2009 and has compounded at around 25% annually since then. Prior to launching his own firm, Christian worked at Xaraf Management, which is a group within Paloma Partners. He also worked at Debt Traders Group, and as well as at Stern Stewart. So a lot of experience from quite different angles, as well as across the capital structure with some distressed investing experience that Christian brings to the table. Christian originally hails from Denmark, has attended the Wharton School, and now lives near Philadelphia, from where he runs his investment firm. Today, Christian will share with us an asset-rich company, as you can see here on the slide, which in his view trades at less than half of intrinsic value. So really look forward to learning more about this opportunity. And with that, Christian, I want to turn it over to you. Go ahead, please.
Thanks, Oliver. I appreciate it and appreciate the opportunity to speak here today. As you can see, the company that I'd like to present today is a company called DHT Holdings, a shipping company, and I believe it's trading at less than half of its intrinsic value. Let's go to slide 2 just for a really brief summary before we get into all the details. So on the summary, you can see the company trades on the New York Stock Exchange under the symbol DHT, recently at $4.41 a share. This is a company that owns and operates 8 crude oil tankers. This is a market which I think is temporarily depressed, and essentially because there's too much supply relative to demand in the industry. It's very simple. Longer term, I think it's almost inevitable that supply will simply adjust to demand, and at that time, I think that that vessels will have a lot of value, and these 8 vessels that DHT owns should really justify a value that is, I think, around $10 a share. So in other words, about 125% above the current stock price. Now, I'd also point out that even at today's low vessel values, I think the stock currently trades at more than a 40% discount to the liquidation value of the fleet. With that, let's go to the next slide, slide 3. Here's just a brief overview of what I'm going to go through today. First, I want to spend a lot of time just giving you some background about the industry. Shipping is definitely an industry that it requires you need to have some background information about shipping, how it works, how to look at a shipping company and how to value a shipping company. And so that's why I'm spending a lot of time on the business. And basically, most shipping companies are really very alike. They really all compete in more or less a commodity business. And so I think analyzing and valuing a shipping company is typically very similar to valuing any other shipping company, at least a shipping company within the same subsegment of shipping. So after I go through that, we'll go into some details about the company, including the valuation, the capital structure, and then we'll finish off by looking at the peers and the catalysts, and then we'll do Q&A. So let's go to slide 4. Now, so let me first tell you, within shipping, for those of you who haven't looked much at shipping before, we have a few different segments. We have container shipping, dry bulk shipping, which transports products like coal, iron ore, grain, and other dry bulks. Then you have refined product tankers, which transport refined products like gasoline, for instance, from refineries to consuming areas. And then you have crude oil tankers, which basically bring crude oil from producing areas to refineries. And so crude oil tankers are an essential part of the world's energy infrastructure. Transporting oil in this fashion is generally much cheaper than land-based transportation on a ton-mile basis. I think in most cases it's even cheaper than pipelines, but it really depends on the logistics of it. And so DHT is exclusively engaged in the crude oil tanker business. This business is a global business. It's not really segmented by geography, with some very rare exceptions. Basically because vessels are mobile and you can move a vessel anywhere in the world fairly quickly, obviously. So, when there's demand in one part of the world, for instance, if there's a lot of demand to move oil from the Middle East to China, vessels will obviously just move to where the demand is. And so you have basically a global day rate at which you can essentially move crude oil. I'll get more to that later on. Also, it's important to keep in mind that the supply-demand dynamics within the crude oil tanker space are completely distinct from the dynamics within other shipping segments like refined product tankers, dry bulk carriers, containers, and other shipping segments. Basically because the ships can generally not be converted, so you can't take a container ship and easily convert it to an oil tanker, or vice versa. So there's a little bit of overlap and some limited exceptions to that. But basically, the supply of ships within each of these subsegments are, really distinct, and obviously the demand is distinct from segment to segment. I also just want to clarify that I'm speaking here mostly of the the crude oil tanker markets that consists of the larger vessel categories. I have them listed here at the bottom. VLCCs, which stands for very large crude carriers. That is basically the largest category of crude oil tankers out there. and then Suezmaxes, the next largest category, Aframaxes, and then Panamaxes. Now let's go to the next page, page 5. So just want to say a few quick words on demands. This is basically a low growth cyclical business. If you look at the last full cycle, and I think you could take the period from 2000 to 2008, ton-mile demand for seaborne crude oil grew at an annualized rate of only 1.8% over that time period. If you look at the factors that have been driving demand and are likely to drive demand going forward, we're mostly talking about the increased oil production in North America and the U.S. and Canada, which has already led to lower imports of crude oil coming into the United States. That's been a factor. In addition, China over the last number of years has accounted for a significant portion of the ton-mile demand growth globally for crude oil. And here I would say that obviously one of the issues going forward is to what extent that continues, especially if this overinvestment that we're seeing in China slows down significantly. That being said, there's still significant demand from other developing economies, and it's not clear that a significant slowdown in China's, let's call it, infrastructure and related sectors would have a dramatic impact on the oil tanker markets. So let me go to the next page and just tell you basically about the types of contracts in this business. And this is very important if you want to look at a shipping company, because you know, this is basically the you know, the terminology that's used, and it's also important to understand how the revenue model works. Basically, there are 3 different types of contracts. You have voyage charters, time charters, and bareboat charters. First of all, let me take a voyage charter. Basically, the way a lot of crude oil is moved is that the customer will have a cargo that they want moved from, let's say, the Middle East to someplace in China, for instance. And they will hire a ship to move that cargo just that one time over that one distance. So basically, you know, the best analogy here is that the crude oil tankers operate like taxis. You know, they'll go from one place and they'll go to wherever the customer wants to go, and then from there they will go to wherever they can find a new cargo. So they'll have a backhaul with ballast until they get a new cargo, and then they'll move that cargo. And this is referred to as the spot market. So here the ship owner operates the vessel and pays all expenses. And there's just, you know, one price that the customer pays, basically. Then we have the time charter, which is where the customer basically leases the ship, or charters, as the terminology goes, the ship for a prearranged period of time, such as 6 months, a year, 3 years, or longer, even 5 or 7 years in some cases. Here, the customer, which is often a big oil company, in some cases it could also be a commodity trader, decides where the ship goes, but the ship owner continues to operate the ship, which means they supply the crew, They pay all the expenses, the insurance, maintenance, etc. The only exception is that the charterer, meaning the lessee, the customer, pays for the fuel and any voyage-specific charges such as port and canal fees. Then you have the bareboat charter, which is really like a pure lease. Typically, these are longer term for a number of years, maybe 5 years, 10 years even. Here, the customer is the one that operates the ship and pays all expenses. When we talk about day rates in shipping, which is really how revenues are always referred to, we always talk about time charter equivalent, or TCE, revenues per day. So for a voyage charter, for instance, you would just take the price of moving the cargo, and then you subtract the voyage-specific costs, like the fuel, port, and canal charges, divided by the estimated round trip, including the time in port. And that gives you basically the revenues per day that the ship owner is earning. The reason why it's called time charter equivalent is because if you look at the time charter, here the owner of the ship pays all the expenses except for the fuel and voyage-specific costs. That's why we subtract those in this calculation. And so essentially the time charter equivalent revenues per day is equal to how much the ship owner is earning per day, except he still has to cover his operating expenses, which is the crew, supplies, insurance, maintenance, basically, and his overhead. And note that fuel, which is by far the most volatile component of the seaborne transportation cost, is not included in the time charter equivalent rates. So you can better interpret what it means. And like I mentioned before, this is essentially a commodity business. There's not really much differentiation. To be a good operator, you have to be vetted by the major oil companies. But you know, there's a lot of price competition, and that's why we see that the time charter equivalent day rates worldwide are almost uniform. Let's go to the next page, supply factors. This is really more important. If when you look at shipping, it's about supply and demand basically, because this is a commodity business. But really, the most important thing to look at in terms of evaluating a shipping company and valuing a shipping company is supply. Now, I'll tell you why. So, important facts are that the vessels are very long-lived. In the case of crude oil tankers, the standard assumption is that a ship will last approximately 25 years. This does vary, but I would say from a little less than 20 years to maybe roughly 30 years is very, very typical. The capital costs are a very big part of the transportation cost. Fuel is the biggest usually, and after that, capital cost is by far the biggest cost. When you order a ship at a shipyard, there's typically a very long lag time from you place the order until the ship is delivered to you, typically 2 to 3 years or so, but it really does vary. When the market is really strong and the shipyards are busy, it'll take longer, maybe 3, maybe even 4 years. When they're not, it could be faster, maybe 1 to 2 years. So we have a situation where the supply of ships out there is fixed in the short, medium term. You don't just go out and scrap a ship because there's a little bit of oversupply, because it's very expensive, and the ships can last for many, many years. It takes a lot before people will go out and actually scrap a ship. in the long term, obviously, the supply is not fixed, and that's because ships eventually get scrapped when they get too old, and ship owners will generally not place orders for new ships unless there's a demand for it, obviously. The last thing I would like to mention about the supply is there's something called slow steaming. This is a relatively new development in shipping, something that started happening after oil prices started going up a number of years ago. So since the fuel cost is the biggest part of the seaborne transportation cost, people started looking more into how they could save money on the fuel. And it turns out that if you run a ship at about half of its design speed, which is basically its full speed, you probably cut your fuel consumption by about 80 to 90%. So a lot of, well, I would probably say pretty much all ship owners have started to run their ships much slower, especially on the backhauls when the ships are typically empty. And as a consequence, they save a lot of fuel by doing that. There have been some technical concerns over slow steaming because the engines are not really designed to go slower than their design speeds. And I think that has caused some delay in the implementation of slow steaming. And some ships have also been retrofitted with equipment that enabled them to slow steam and save a lot on their fuel bill. Now, what does this mean for supply? Basically, when the ships are out on the water for a longer time period to move the same cargo, essentially that is effectively a reduction of the supply. So that has certainly helped the supply-demand balance recently. There's some uncertainty about how much further potential there is for slow steaming to effectively reduce the effective supply of ships. And this is very important because there's oversupply in the industry at the moment. You know, there's some controversy over it. I think there's likely a little more potential, but it certainly is an uncertainty factor. I think you could certainly say that it is a buffer when the market is weak, as it has been for some time now. There is more of an incentive to slow steam. And when the market is strong, there's less of an incentive to slow steam, because when the market is strong, ship owners want to move their ships quickly and pick up the next cargo to make more money. But when day rates are low and the profit is so low anyway, it makes more sense to try to slow steam, earn less revenues, but also cut your fuel bill significantly. So this is having a little bit of a dampening effect here on the downside. Let's go to slide 8 and take a look at the day rates. So this is basically what I referred to earlier, the time charter equivalent revenues per day. And what I've chosen to show on this slide is the historical day rates for VLCCs, very large crude carriers, which, like I mentioned, is basically the largest category of crude oil tankers. Now, if you look at this chart, it goes back to 1990. You see that there is significant volatility in this. And so what's the reason for that? Now, the reason is you have a combination of a supply which is fixed in the short and medium term. In addition, on the demand side, you have a very inelastic demand. The reason for that is that the seaborne transportation cost is usually very low as a percentage of the value of the cargo that is being moved. And so basically, when somebody needs a cargo moved, say a shipment of oil from the Middle East to China, the transportation cost is so low that it really doesn't affect their decision making very much at all. They will get the best price because there's no reason not to, but the demand is barely affected by the day rates, really. So as a result of these two factors, we have a situation where the supply-demand balance can very easily get out of balance. If demand changes a little bit and the supply doesn't adjust in the short term, you can have a huge increase or decrease in the day rates. And the customers will pay much, much more because it's a very low cost anyway. If we look at the chart, we see that the 90s were actually a fairly depressed period. There was a little bit of some strength in the early 90s, which came off of a very weak period in the 80s following the oil crisis when the tanker market was extremely depressed for a very long time. I won't go too much into that, maybe in the Q&A if we have some time. But basically since the 2000s, we've had some undersupply, and we've also had a lot of demand from emerging markets, especially China, and that has caused generally strong day rates up until the recession started in 2008, basically. Let's go to the next slide, slide 9, and look at vessel values. Now, this chart shows the price of a new ship, and again, this is for VLCC. The price of a new ship and the price of a 5-year-old ship, the second-hand price, going back also to the early 90s. And here we can see that vessel values historically fluctuated pretty much in line with the day rates. Obviously, investor sentiment, things like that, also affect ship prices. Today, I would say that the lack of financing to buy new ships is also affecting prices of ships negatively because there's not much financing available. But basically, we see that when the markets are strong, people want to buy ships, and they push up the prices of the ships. And when day rates are weak, obviously people don't want to invest in ships, and we even have some distressed sales from players who are not making enough money to cover their debt service. The price of a new ship also varies based on the same factors, also based on the price of steel to a certain degree. This is an industry that's very susceptible to cycles because of the lag that I mentioned earlier between the time when you order a ship and take delivery of the ship. Basically what happens is that, during the good times, like from about 2003 to 2008, when day rates were strong, people were investing in ships, pushing up the prices of ships, both new ones and second-hand vessels. And then when demand dropped after the recession, ships continued to be delivered for a few years because of the lag between ordering and delivery, and that just further widened the gap between supply and demand. And obviously that drove down both day rates and vessel values. We actually had a little bit of a rebound in demand for ships in 2010, but I'll get to that. Let's go to the next slide, slide 10, and talk about the current situation in the industry. So, like I just mentioned, we had overordering of ships during the strong period from 2003 to 2008. Since 2008, nobody's been ordering ships except for some deliveries, some orders that were made in 2010 when we had a bit of a pickup. Because of this lag time in delivery, for crude oil tankers, we're basically seeing the end of this big wave of deliveries happening here in 2013. And if you look at the deliveries that are scheduled for 2014 and beyond, it's very, very low. So essentially, I think that we're essentially going into a period where supply can finally begin to adjust downwards to demand. How will that happen? First of all, it'll happen by old ships being scrapped, and at the same time an absence of a lot of orders for new ships. Unfortunately, the scrapping rates will likely be fairly low for a few years because the global fleet is very young because of this big wave of ordering in the last number of years. Another point that's important to consider is the possible availability of more fuel-efficient vessels that the shipyards might be able to develop in the future. To the extent that this happens, you could have deliveries of new ships in the coming years in spite of fairly weak day rates, and that would certainly be a negative for old ships or existing ships. However, I think this will be very muted. It will take place over a very long period of time. I think the market has to get significantly stronger before we see anybody placing a lot of orders for newer and more fuel-efficient ships, because I doubt that the fuel savings are really big enough to justify it given how low the day rates are today. And also, in terms of the technology, the shipyards for the large crude oil carriers have only just begun to come out with designs for more fuel-efficient ships, and so far we don't really know how good it really is. But I think the key is that even with the fuel savings that you're supposed to get from these new ships, you will likely have to see higher day rates before a lot of industry players will place significant orders for new and more fuel-efficient ships. And the final point is, after the drop in 2008, a lot of banks, and most of the banks that lend to shipping companies are European banks, completely withdrew from the shipping business. So there's a significantly less availability of financing. Let's go to the next page and talk about how to value a shipping company. So as you can probably figure out, a shipping company doesn't really have any franchise value to speak of. Capital allocation is important, and the balance sheet is important, but this really is a capital-intensive commodity business. So the value of a shipping company is pretty much equal to just the value of the individual vessels they own. Since ships have a limited useful life, you can't really use a multiple of earnings, because if you have a ship with 3 years of useful life left, obviously it's worth a much, much lower multiple than a ship that's got 20 years left on it. So really the only way to value a shipping company, I think, is to base it on the net present value of the cash flows over the remaining useful life of the ship. For old ships, the scrap value is more important and can serve as sort of a floor under the valuation. The most important thing to take into account in projecting the cash flows is estimating what day rates will be going forwards, and I'll get into that a little bit more. A concept that's used in the industry is NAV, or net asset value per share. This is basically the liquidation value of a company. This is the same as the tangible book value per share, except you use the current market value of the ships, basically based on the second-hand prices you could achieve in the market today if you liquidated the fleet. Use that instead of the book value of the fleet. This is obviously of limited usefulness because it's a circular logic. The values of the ships is based on how much more cash flow the ships can generate, and that's exactly what we're trying to figure out. But nevertheless, liquidation value is sometimes an interesting metric to look at. Let's go to the next page and talk about the company DHT in some more detail. Now that we've talked about the industry in detail, DHT was spun off from OSG, Overseas Shipholding Company. Overseas Shipholding Group back in 2005. Initially, it purely leased its ships on long-term contracts to OSG, but about 2 to 3 years ago, the company got a new management team and began transforming its business model to being more of an independent operator operating in the spot markets. Also, the charters with OSG have either expired or been canceled because of OSG's bankruptcy. The stock price is down very dramatically over the last few years, primarily just because of the weakness in the industry since 2008, but also OSG's financial distress has played a role. In addition, they did a reverse stock split a little bit less than a year ago, and I think that's probably also had some negative impact on the stock price. The company today owns 4 VLCCs, 2 Suezmaxes, and 2 Aframaxes. All of them except one are operating, all of them except maybe 2 or 3 are operating in the spot markets, and the rest are operating on very short-term time charters. Management's objective is to grow the company over time. I think compared to most shipping companies, this management team is more concerned about not weakening the balance sheets, which I think is a significant positive. The company did an equity rights offering in April last year, basically to strengthen the balance sheet. The equity rights offering was backstopped by Anchorage Capital, which is a approximately $10 billion private equity firm, which ended up owning about 32% of the company on a fully diluted basis because they backstopped the equity offering. Anchorage chairs the board's investment committee and can veto vessel acquisitions, and I think in practice they probably control the company because of their large holding. I think the presence of Anchorage Capital is a significant positive, especially considering the significant amount of debt that DHT has, which we'll get to in a minute. I think it's possible that Anchorage could supply capital in the future, whether it's in case the company has trouble refinancing its debt, or whether it's to raise capital to grow the company further. Let's go to the next page, talk about the capital structure of the company. So basically, on a fully diluted basis, DHT's market cap today is, well, as of 2 days ago, I think, $68 million. The company had a $50 million cash balance as of the end of the first quarter. That's pro forma for some payments that they expected to make here in the second quarter. After those payments are made, it will be $50 million cash balance, which is $3.27 per share. The cash is unencumbered, so they can basically do with it whatever they want, except they need to keep a minimum of $20 million, according to some of their debt agreements. Have $155 million in debt, which is secured by all of the vessels in the fleet. Very importantly, the company very recently removed the loan-to-value or LTV covenant for most of the debts. I think this is a very significant positive because this means that if the market value of the fleet drops, that will not cause acceleration of the debts. After the removal of the covenants, the company doesn't really have any principal payments until 2016. Most of the debt then has to be refinanced if it hasn't been repaid in 2017. There's good asset coverage, and I'm really not significantly concerned about the debt, but it certainly is a meaningful amount of debt. I would probably say that the company is just slightly below investment grade quality. The LTV is 56%, and that's based on the current vessel values, which we saw in the previous slide, are near historic lows. They don't have a need to refinance for a while, and I think it will probably be long enough for either the industry to recover or for the company to generate, enough cash flow that it'll be easier for them to refinance. Currently, the company is generating roughly $11 million per year, but as you saw earlier, the day rates vary dramatically over time. So, this number is not really that important, and it'll vary dramatically as day rates vary. I believe that an increase in the day rate of $10,000 a day, and I think in the first quarter the company was making about $13,000 a day, but a $10,000 increase would increase their cash flow by $28 million per year. So essentially that will take you to $39 million per year. The slide that we saw on a previous page with the day rates going back to 1990, I think the average over that time period is a little less than 40,000 a day. So based on the historical averages, there's dramatic upsides in the company's cash flow generation. I think I've already talked about the rest of the points, so let's go to the next page and talk about the valuation. The liquidation value of the company, I estimate at $7.83 a share. This is, again, based on the current low secondhand values of the vessels, which are near historic lows. This is even fairly conservative. I think based on the price that the company achieved for one of their vessels in the first quarter, it looks like the liquidation value really could be above $9 per share. But we'll be conservative and go with the 783. A DCF, which I certainly don't have time to go into in detail, which I did based on a $32,500 normalized day rate, and an assumption that it'll take another 4 years before we get back to normalized in the industry. That gives me a value of about $14 a share. I think it's prudent to reduce the valuation a little bit for two reasons. One is the significant amount of debt does mean that you have at least moderate risk of financial distress. And secondly, because the company wants to grow over time, I think it's likely that they will do equity offerings in the future. When a shipping company does an equity offering, if it does so, if it's priced below the NAV per share, which is essentially the liquidation value per share, it destroys value for existing shareholders. Or if a shareholder decides to participate, it will reduce their percentage return on the stock. This is because the NAV per share is essentially, because it's the liquidation value, an indication of the kind of price they have to pay for the ships that they will buy with the proceeds of the equity offering. And since the stock is trading so far below the NAV today, if they do an equity offering at some point, I think it will likely be value destroying. So for those reasons, I think it's prudent to take the valuation down to about $10 per share. I think that's a little conservative, actually, but that's still about 125% upside from the current stock price. On the next page, let's just take a brief look at the peers, and I apologize for the small print in the table here. Here are 5 peers which are relatively comparable, and as you can see here, DHT is the cheapest on both a leveraged basis and an unleveraged basis, and even significantly so, even though it has the second lowest leverage among these companies. I think the lower leverage is a significant positive because the risk of financial distress is lower. Let's go to the next page real quick and talk about the catalysts. I have to admit that there are really not a lot of catalysts with this investment. The main catalyst is the industry recovering. I think this is almost inevitable to happen because in the long run, we've seen that supply always does eventually adjust to demand because people simply will not order new ships unless there is a demand for it. So I think that it's really just a matter of time before we see a normalization of day rates. In addition, I think in the shorter term, it's somewhat likely that the company will be re-rated more in line with its peers, which will also lead to a significant increase in the stock price. I think probably the main reason why the company is trading below its peers is that it's smaller. So with that, I'll open it up for Q&A.
Thank you very much, Christian, for that very thorough presentation. I'd like to just remind everyone that if you would like to ask a question, you can type it into the online interface. We have about 10 minutes for questions. We do have a few questions. First of all, how is the lack of financing in the industry affecting the supply of ships?
Well, it certainly is a positive. I think if you go to slide 15 and look at the peers, you see that the leverage for 4 of these companies is in the 80s or the 90s, and that the leverage here is defined as loan to value, basically, and that's actually based on the liquidation value of the fleet in this table. So most shipping companies, in my opinion, are over-leveraged, actually. And historically, the industry has relied very heavily on debt financing, mostly bank financing. That is a real problem for anyone that wants to buy a new ship today because, like I mentioned earlier, a number of European banks have completely exited the market. So it's difficult to get financing today. LTVs are definitely lower than what you could get before the crisis.
I'd like to just go to Oliver quickly for a couple more questions and then we'll continue.
Thanks, John. Christian, just a couple of quick ones from me. One on the fleet age. What's the average fleet age, and then also what's the break-even rate, the cash cost break-even rate for the 4 VLCs or for the whole company?
Sure. So I think the average age of the ships in DHT's fleet is, I think it's very close to 10 years. So I would say roughly, ideally 15 years of remaining useful life. And your other question was about the cash break-even. DHT actually has a very low cash break-even. The operating costs per day in the first quarter were about 6,500, and given their fleet, which is half VLCCs, that is actually a very, very low operating cost. This has come down very dramatically for the company because most of the ships were run by a technical manager associated with OSG, which is the company that DHT was spun off from back in 2005. And that was related to when OSG was leasing all of the ships in DHT's portfolio. OSG really had a reputation for being an inefficient operator, and you can really see in the last 2 years when they've moved the technical management over to a different technical manager than OSG, the operating costs have really dropped dramatically. So they're in an excellent situation, and it's very helpful in a situation where day rates as low as they are today, that you have an advantage versus your peers, and you can still probably generate a little bit of positive cash flow when your competitors are just breaking even. So if you just take operating costs, not including the overhead or the financing costs of the company, it's about 6,500. I don't recall how much it is if you include the overhead and the debt amortization, but I know that it is one of the lowest in the industry.
That's interesting, and I guess certainly leads to that cash generation even at these low levels. I just before I turn it back to John, I was curious also to get your view on if you looked at the restructuring at Frontline and what John Fredrickson is doing with the Frontline 2012. He speaks a lot about that fuel efficiency and stresses how his fleet is only, I think, about 3 years old, and he's looking to grow it aggressively in this downturn, in a way making a point that a lot of the existing ships are older and not as fuel efficient. So in a way, there could be an argument about bad assets with a lot of companies in the industry, and how you view that in the case of DHT.
Yeah, I have to say I'm not deeply familiar with Frontline. I'm somewhat familiar with it. I think John Fredrickson has a reputation for being very aggressive, and I don't think there are a lot of people out there who are in a position to really order a significant number of these new, more fuel-efficient ships, even if they want to. If you look at VLCCs, for instance, which is the largest vessel category, there's more than 600 ships out there in the global fleet today, and if you look at the scheduled deliveries, as soon as this wave is ending here this year, I mean, we're looking at tiny numbers of ships, which are not going to affect the supply-demand balance significantly. I think it would really take a lot to really affect the supply-demand picture in a significant way. I think ultimately the way to really look at it is just to see how much more fuel efficient are the new ships, and how much lower of a day rate can they operate at, and make the same amount of money as an older ship. Because you could argue that eventually when the new ships become sort of the dominant or the marginal ship in terms of the price setting of day rates, which would take a really long time, then eventually day rates could be depressed by that amount, basically, by the amount of that fuel saving. From what I hear, it is not that much. It certainly should be significantly less than $5,000 per day, probably $2,000 to $3,000, maybe let's say $3,000 a day. I have to stress that there's a significant amount of uncertainty about how much the fuel savings really are, and I've heard industry players say that the fuel savings that the shipyards are promising are just completely unrealistic, whereas others, like John Fredrickson, I suppose, are saying that they are really substantial. So I think it certainly is a significant uncertainty, and it certainly is a negative. But I must say I have trouble seeing a situation where it really dramatically changes the supply-demand picture in the industries, at least in the next number of years. At the same time, I think with DHT you have a significant margin of safety buying it at such a low price, and the assumption for day rates in the valuation that I used on the conservative side, I would say.
Great. Well, thank you, Christian, for this compelling idea. I want to go back to John for any further questions. John?
Thanks, Oliver. A related question, could the distress that OSG and others are experiencing result in irrational pricing for a long period of time for the industry?
No, I don't think that the distress will really affect day rates, if that's what you're referring to. Basically, day rates, I think, theoretically they can really only go a little bit below the marginal player's break-even cost. You can go a little bit lower than that because the alternative to operating a ship is to lay it up, which does have a small cost associated with it. I think the financial distress, no, I think distressed players are less likely to, in fact, extremely unlikely to buy new ships. I don't see OSG or anybody like that investing in new ships while they're in bankruptcy or potentially close to bankruptcy. So in that way, it's actually a positive. And I also don't see any reason why you should be pricing below break-even just because you're in bankruptcy.
I think we're almost out of time, but I'll take one more question. Can history be a guide to say, on average, how long these industry cycles in shipping tend to last?
No, I don't think so. You have to look at the actual reasons why the cycle is occurring. In the 80s, you had a very, very long and horrible depression in crude oil tankers, at least. And that was because of, I think, overordering of ships, dramatic overordering of ships in the 70s, followed by a horrendous drop in demand after the second oil crisis in the early 80s or thereabouts. And I think today, there's no way that, there's no particular reason to think that we would see anything like that. I think you have to look at the specific dynamics of the situation today, look at how oversupplied we are today, and how long will it basically take us to get back to balance. So I think it's not a very good guide in terms of narrowing down on the likely exact duration of the cycle.
Well, I'd like to thank all of you for attending this session, and special thanks to you, Christian, for being with us and for taking the time to share such in-depth insights both into the industry as well as into DHT.
Thank you. It was my pleasure.